Well, hello, Twitter, Facebook, LinkedIn, and YouTube. Different week this week. It is July the 23rd, I believe, because I'm going on vacation tomorrow. And believe it or not, our good friend Andrew Keene is getting married. So he is not with us today. Nonetheless, I felt obliged to record a show, because how can I send out the newsletter without a video? But maybe it will be a little bit shorter than usual. This week's show is built around this week's newsletter, which is titled Our Blockchain Future. Elon Musk, Jack Dorsey, Cathie Wood, Fred Wilson, and Michael Arrington all weighed in this week on Bitcoin, and it forms the centerpiece of this week's newsletter, which you can see here. Now, it is actually a really, really interesting week, and a very, very interesting set of conversations. So let's dig in. Most important thing this week in crypto was that everyone paid attention. And the reason they paid attention is that two things happened. First, Bitcoin dropped under $30,000 for the first time for a long time, which led to lots of speculation that Bitcoin was finished. And in the very same week, Elon Musk, Jack Dorsey, and Cathie Wood of the ARK investment firm had a live discussion broadcast on CNBC about their attitude to blockchain and to Bitcoin. And in that, although there was a wide range of views, they pretty much all agreed that the future, our collective future, is tied up with Bitcoin and with blockchain. In the case of Jack Dorsey, he pontificated on the possibility for world peace, driven by the fact that blockchain and Bitcoin are non-national global overlays, if you like, that get around the competition between nation states that often leads to war. Elon Musk said that probably Tesla will start allowing you to buy cars with Bitcoin in the future. And Cathie Woods made a big bet by buying 145,000 Bitcoins on the Bitcoin Trust, the ticker symbol GBTC. So all of them said and did things which indicate an optimistic and a positive view of what our Bitcoin future is. But my interest was piqued not so much by that media event, but more by Michael Arrington, my old friend and business partner from Archimedes Labs, and via that TechCrunch, where he was interviewed on TechCrunch about the next chapter in his journey as an investor. Disclosed that he and his family have moved to Miami, which I wish him the best with. And although he did move there in February when the weather was not so hot, so it'd be interesting what he thinks about it in the middle of July. But more important than the fact that he moved to Miami is the fact that he published a lengthy piece of work at Arrington Capital, Arrington XRP Capital, defending his fund's investment in Algorand. Algorand is a blockchain, very like, say, Bitcoin is a blockchain. It's known as a level 1 or tier 1 blockchain. That is to say, it isn't built on top of anything else other than code. The idea is that we collectively will build on top of it, just as we build on top of Ethereum and Bitcoin. And in the research piece, he spoke at length about why. And that disclosed a way of thinking that I found very attractive. And here's the short version, and I write about this in my editorial. He made the point that because Bitcoin is slow to complete transactions, developers have flocked to build what are known as level 2 solutions. So whether it's a distributed finance solution offering high interest rates on loans, or if you stake crypto or almost anything else, he made the point that this is all being done at level 2. And when something is done at level 2, if it's architected incorrectly, it leads to a centralization and a single point of failure and a dependency typically on a corporation rather than a protocol for the outcome. He rightly points out, and I don't think he was the writer of the piece, by the way, so when I say he, I mean Arrington XRP Capital, rightly points out that that leads to the exact opposite of the promise of the blockchain, which is a distributed, trustless architecture. So instead of trusting a third party, you're meant to be able to trust the network without needing to trust any human being. And Bitcoin achieves that. Ethereum achieves that. Arguably, the second level solutions largely do not achieve that, and if are closer architecturally to the current internet, where we all rely on an Amazon or a Google or a Facebook or some other centralized authority. I think that's something that isn't being said and is extremely true. And it has massive implications for whether blockchain is a viable solution to the problem of centralization, governance, authority, and trust. If everything was built at level 2, it wouldn't be. So the point about Algorand is that Algorand has done a couple of things. Firstly, it is built a level 1 blockchain that is fast, far faster than Bitcoin is today. And secondly, it's done so without compromising decentralization. And thirdly, it's built in a reward system that doesn't rely on mining, but relies on staking. That is to say, owning the Algorand coin and being prepared to leave it in place as a stake. And if you do that, you will be rewarded in additional coins as a reward for your staking. People can still run Algorand nodes, but they won't get paid for that. It's the staking that lets you get paid. So it's decentralized, it's fast, and it has a built-in reward structure. And for all those reasons, the fund believes that it has a viable future, a future as a decentralized authority, a decentralized trustless architecture. So I thought that was great. I think the white paper that it's based on is definitely something that I linked to in the newsletter, and I do recommend that you read the long version if you're interested in this space. It's probably a bit much if you're not, and the short version will suffice. Now, that was interesting, not in and of itself, but it was interesting for a second reason. One of the SEC commissioners, referred to by Fred Wilson of Union Square Ventures, made a statement this week. For those of you who are familiar with the SEC, that's Hester Pierce. He made a statement when asked about stable coins, whether he thought the US government should create a central bank digital currency. This is a very popular thing these days. Many central banks are talking about creating a central bank digital currency, replacing paper and coins with a digital version of the currency. And his answer was no. His answer was that the private versions of the US dollar, there's two that are very well known. One is Tether. Its token symbol is USDT, and the other is USDC. Tether it holds $62 billion in US currency as a back to its digital currency, and USDC holds $27 billion in US dollars backing its version. He argued that these two private market solutions are better than a government solution because it creates competition and the likelihood of innovation at pace than if there was just a single US dollar version. So that said, Fred Wilson, in reading that, amplified it and made the point that it is very smart to rely on private companies to print stable versions of the US dollar. And I thought that was remarkable for the same reason that the Arrington XRP piece is remarkable, in that it focuses in on the need to replace government with network-based governance that doesn't rely on individuals or companies, but can be trusted and auditable, by the way, as well. So, so I thought that the Wilson piece and the XRP Capital piece were both thoughtful, deep, and important in the space, in a way that perhaps the Dorsey, Elon Musk, Cathie Wood's conversation was not. It didn't really throw a lot of light on the space. I thought it was encouraging that Dorsey believes that Bitcoin is going to play a big part in the future of both Square and Twitter. And I think that that is interesting in the context of the creator economy and the question, how are people going to be rewarded for both their attention and their effort in the creator economy? And there's a deeper conversation there about how that might pan out. So it isn't that the other conversation was uninteresting, but it was not as important to the future of the platforms as the other two pieces were. So those conversations form a big part of what I talked about this week. There's a very big section on venture capital again. The section on venture capital kicks off with Index Ventures announcement, the Reimer brothers founded fund, that they have raised a total of $3 billion across 3 new funds. It's a $900 million early stage fund, a $200 billion growth stage fund, and a $200 million seed stage fund. Why is that interesting? Well, we've been talking a lot on That Was the Week about the 3 different asset classes in venture: seed, venture, and growth. This $200 million for seed, $900 million for venture, and $2 billion for growth is a pretty good reflection of the entire value chain within venture. And I think it's very smart of Index to be playing in all 3 buckets, with roughly right sizing each of the buckets. A $200 million seed fund can easily return 50 to 100x the fund if it's properly deployed. By having a $900 million venture fund that can put money into the winners from the seed fund, that pretty much risk mitigates the seed money and makes sure that the winners win big. And that's exactly the same as the growth stage fund. So just as Tiger Global are stretching themselves to, in their case, backwards into the earlier stages, Index, which began in Europe as a small fund, is now in all 3 stages. And I think this is going to be a story that's going to run and run and run. It was amplified this week by the fact that Silver Lake, a private equity fund, led the latest funding round into Carter. Carter is the company here in Silicon Valley that started by managing share tables for startups, and today is the owner of Carter X, which is a private marketplace for funding later stage startups. They raised at a valuation of $7.5 billion, and Silver Lake, not normally a venture investor, led that round. And that again is significant for what's happening in venture capital. A lot more in the newsletter this week about that. Venture capital, but I think that's enough for us to mention here on the video. Again, there's a section all about liquidity. Liquidity is how investors, at the stage where a company's shares become tradable, can cash in on their earlier investments. China this week acted in such a way as to lead to speculation in the South China Morning Post that the government there is stopping Chinese companies from listing on the New York Stock Exchange, a major source of liquidity for Chinese investors. So that is actually a really big deal for anyone investing in China. And again, there's a big section on Twitter's transformation as it modifies Twitter to add down votes, so that if somebody comments on your tweet, you can downvote it. And it also added voice manipulation to Twitter Spaces, so you can sound like, for example, a robot when you speak on Twitter Spaces. Both pretty trivial, I thought, but these happened in a week where Twitter announced the best revenue for 24 months, and its stock was boosted in the stock market immediately afterwards. Probably the most substantive decision of the week was Amy Klobuchar's decision to repeal or to try to introduce a bill that will repeal part of Section 230 protections for tech companies, something, again, Andrew and I talk about a lot on the show. And this week, she was trying to make it, to carve out medical misinformation as being an unprotected content type. My prediction is she will not be able to pass this bill, and that it is a mistake to try to make social media responsible for what is published on it. But she's right that there's lots of medical misinformation on social media. And for me, the antidote to that is lots and lots more medical information, not misinformation, rather than seeking to punish the platforms for what people choose to publish on them. But you all know that, I think that. So the less said about the better. Startup of the week this week. Startup of the week is Zoom. Why? Because Zoom just agreed to spend a very large percentage of its market cap, 14.7 billion, when its own market cap is about 100, on buying Five9. Now, Five9 is a call center company, a digital call center company, and by deciding to spend such a large percentage of its stock on buying Five9, Zoom is signaling that it sees its future in the enterprise, and specifically in enterprise services, and particularly in customer-facing services, which means it's entering the space of, for example, Salesforce and other big CRM players. I think it's a smart move. I think it will make money. I do think call centers will ultimately be distributed, digitized, and not take place in massive offices with kiosks. And so my startup of the week is Zoom. And finally, Andrew's favorite piece, Tweet of the Week. Tweet of the Week this week is from Michael Arrington, who says the following: "My day began with a man I met poking me in the belly and telling me that I look like Chris Christie." And now you come to mention it, Mike, you do look a bit like Chris Christie, only a younger, handsomer version. And it ended with an SEC subpoena on a deal that we, meaning Arrington XRP Capital, invested in. See you all tomorrow. I thought that was a great Mike tweet, just because it is Mike to tweet those two things. I want to say that I hope the SEC subpoena is something you can fight and win. I do think the SEC is proving over and over again to be so woolly on what the rules are governing cryptocurrency, what is a stock or a security, and what is a token, and therefore not a security, what is money, and so on and so forth, that it's almost impossible for anyone to make a smart decision without fear that they will come after you, and that has to be fixed. So that was the week. This is at least 10 minutes shorter than a show with Andrew, and probably a lot more boring, but it is what it is. I will see you all next time we're here, which will be next week, the weekend, I think. Bye for now.